Hi there, welcome to Kneppy Invest, and welcome to our sort of answer and reply video. The reason I say sort of is because I am only going to be addressing two questions or comments in this video, and both questions or comments are related to ASX banks or the four big banks. And I think addressing these two questions or comments is intriguing or interesting because I found them fascinating. Found them really fascinating. And what I want to do in addressing these particular questions or comments is I want to leave my opinion out of the equation. So by the end of the video, if I am successful, you won't be able to tell if I'm bearish or bullish on the banks, or even if I agree or disagree with these questions. I want the numbers to speak for themselves. Now, if you do watch a lot of my videos, you will know what my thoughts are about the banks. But I'll try to be as unbiased as possible in this video. So let's go to the first question from Andreas GX1H. Kneppy, what do you think about banks for a long-term hold? Seem pretty solid, 30%-ish yearly returns. Just want your thoughts. Now, there was a couple of nice little replies, and the reason I say nice is because any reply from you is nice. Stu Percy said, or answered, which bank, or questioned, which bank has had 30% returns? Good question, I think. And then HBK Fortis, by the way, that which banks have had 30% returns depends on your time frame, because within the past year, the banks have given greater than 30% returns. In fact, I would assume between maybe 50% and 60%. Anyway, let's go to HBK Fortis. If you buy a big bank during a dip, maybe you get some value. Otherwise, they are generally overpriced. I won't say if I agree or disagree with that, but it's another good reply. And Andrews then replied to Stu Percy and also HBK Fortis by saying, Stu Percy, majority of them, the banks in the past year, have given those sort of returns. In fact, higher returns than 30%. So he's not wrong there. In fact, I can show you the returns of all the banks in the past year. However, past performance is not the best indicator of future. That is absolutely perfect. Absolutely true. In fact, when I look at returns for companies, no matter what company it is, I never look at 1 year returns. I always focus on 3 year, 5 year, preferably 10 years, because in the past year, it's just noise. You can't rely on the past year to determine what sort of returns are likely for a company moving forward. So I always look at the past 10 years. Preferably, maybe sometimes 5 years, on the rare occasion, 3 years. He also answered HBK Fortis. Totally agree, they are definitely overvalued and will be majority of the time. That's not absolutely true. In some instances, the bank's actually quite good value, even at cheap. Particularly if we see a significant downturn in the economy, the banks will be absolutely sold off. Don't forget, banks are cyclical. We saw that during the COVID, what's that thing called, the GFC? The banks fell a lot and they were cheap. In fact, over the past 10 years, the bank have been cheap, in my opinion, quite often. So yeah, that's what I'm going to say when it comes to that. Okay, the way I'm going to address this question is by going to FinChat. And with FinChat, you can look at the returns, the total returns of the banks over the last 1 year, 3 year, 5 year, and 10 years. Now, total returns is share price and also dividends. And that is the way to look at the banks. Now, interesting enough, and another thing I should say here is the banks have had a really good return for shareholders in the past year, and that will distort the total returns over the last 10 years. Because if I did this exercise 1 year ago, the total returns of the banks would have been significantly lower. So keep that in mind as well. Now, let's start off with the Commonwealth Bank of Australia. I'm not sure if I'll go through all the banks. Definitely want to look at CBA. Now, in the past year, and this is price, I have to go to total returns. Price, CBA price up 46%. Oh no, that's total return. Share price is up 41%. So the difference between share price and return is just the dividend, and total return is 46%. So significantly higher than 30%. So if you just had a look at the total returns of the banks in the past year, you'd think, what a great investment. The future is bright for these companies. But again, it's a past 1 year. Now let's have a look at the past 10 years. The total return of CBA is a nice 11.5% per year. So I'm looking at CAGR, compound annual growth rate, 11.5%. It's actually not bad. It's actually pretty good. I wouldn't mind 11.5% return for a bank. If you look at the share price, it's about 6%, I would assume, 6.34%. So again, the difference between the price and the total return is that dividend, which is a nice dividend, 5% dividend yield for the banks or the CBA over the past 10 years. Now, the next part of the question is, can we expect this to continue in the future? Now, this comes back to what you think about the banks over the next 10 years. Are you really bullish or are you bearish? And all I have to say is, in the answer to that is, let's have a look at the past. How have the banks performed in the last 10 years? And what I'm going to do is just have a look at some of the financial metrics: revenue growth, earnings per share growth, and also dividend per share growth over the past 10 years. Now, unfortunately, FinChat doesn't have revenue growth for Commonwealth Bank over the last 10 years. Don't know why, but over the last 5 years, revenue has grown at 3.21% per year. Earnings per share have grown over the past 10 years at 0.73%. And over the past 10 years, dividends have grown at 1.5%. So the conclusion you can draw from just looking at the growth in the CBA, this is not a growth company at all. It is not growing. If it is growing, it's barely growing at all. So what is going to drive this 30% return over the next 5 or 10 years? So that's the question I want to ask you. What is going to drive 30% returns for this company over the next 5 to 10 years if they're not growing or they haven't grown over the past 10 years at all? The other thing I won't mention the dividend yield. I'll mention the dividend yield when I answer the next question. Okay, so this is a CBA. Let's turn our attention to one other bank. Which one? I'll turn my attention to ANZ. I had a quick look at Westpac, but ANZ is quite illuminating. And the reason I say that is if you go back to the last 10 years for ANZ, the share price has actually gone backwards. CAGR of 0.27%. So in a way, you've relied upon dividends to get any sort of return out of ANZ. And you can just see that in the chart. It's gone sideways. Share price has gone sideways. Hasn't grown at all. And we'll turn our attention to the financial metrics in a second. If you have a look at total returns for ANZ, it's just going to be the dividend yield, 5.6% per year. So all you're getting from ANZ is the dividend yield. That's 5.6% per year. So this is very important moving forward. When we look at the dividend yield right now for ANZ, that is expected return of ANZ over the next 5 to 10 years. It's the dividend yield. That's your expected return. Okay, so let's have a look at some of the financial metrics of ANZ. Again, for some reason, revenue growth is not there in FinChat, but revenue over the last 5 years has grown at 1.99% per year. Earnings per share at 0.06% per year. And dividends have actually dropped 7.36% per year over the past 10 years, which is a bit of a concerning fact. The dividends are dropping, and more likely, the only reason you're owning shares in this company is for the dividend. You don't want to see dividends dropping if you have bought some shares in the company just for the income. Okay, so that's CBA and ANZ. I'll let you draw your own conclusion. Can you expect CBA and ANZ to grow at 30% per year over the next 5 or 10 years, or for the longer term? I know what my answer would be, but address it yourself. Ask yourself that question just by looking at these numbers. Okay, let's get to the second question. And this was released, I think, in the last 24 hours. So I have to go all the way back up. All the way back up to the top. So a lot of comments from Stuart. And I have to find this question. I actually did answer this, by the way. Here we go. This is it. This is from Swimming 11. So not really, this is just a comment. My grandma just sold one of her investment properties and put all the money into bank shares as she thought it would give a steady income. She is not concerned about share price up or down, so people buy for different reasons. That actually is true. One of the reasons why people might buy the banks is because of the dividend. It's fair enough. It's a nice little income. Maybe you could say even reliable income, although I would question that because the banks are cyclical. And if there is a significant downturn, you can't really rely on the dividends maintaining their banks maintaining the dividend. In fact, we saw that during COVID-19. They actually suspended the dividend. So it's not absolutely reliable. So that is actually a little bit of a myth. They're actually not reliable. But this is what really drew me to this question. is you're relying on the dividend yields because we're already seeing that ANZ is not growing. Even CBA is barely growing. I'm assuming the same is true for NAB and what's the other one? Westpac. They're barely growing. And maybe your expectations moving forward is you are going to see some pretty good growth in the banks. I'm not sure where that is going to come from, but again, I want to leave my bias out of it. Now, Rick Thellion answered, diversification of different banks is encouraging amongst investors. If a sector like oil or other mining like lithium go down, other investments that have increased or balanced are less. Then he actually mentioned what I thought about the banks. So let's move past that. And that's a fairly long question, so I won't go into all that. And then I answered, I don't understand this. The dividend yield on the banks are lower than the return you can get on term deposits you can get at the same banks in some cases. Higher risk, lower returns. And then Swimming 11 just answered 30 minutes ago. She wanted to buy the shares now as she worried once interest rates start to drop next year, then more investors will seek our shares for the high return plus the franking credits. I understand you can't time the market, so you just went for it. So I'm going to address this, and particularly around the dividend yield, which I find really fascinating because, as I mentioned, I had a look at CBA. CBA's dividend yield is lower than term deposits. And the whole reason that's interesting is because there's no risk in term deposits. There is a risk in holding shares in banks. And the risk is your capital might drop significantly. Now, the other risk is dividends could drop significantly as well if we do see some trouble with the economy. And in fact, the dividends could drop to zero for a short period of time. Don't know why this is on. I do know why it's on Wagners. I went to ComSec because they have a little summary area and they have a little dividend section, and it said the dividend yield is 1.7%. I went, that's wrong. That is wrong. The dividend yield of CBA is not 1.7%. I don't know how ComSec could get that wrong. So what I did is just my own calculations, and the dividend yield for CBA is like 3.5%. I then went to FinChat, and then I had a look at CBA, and yeah, FinChat has a right. I think what ComSec is doing is just looking at the last dividend, the interim dividend, and just equating that to the dividend yield. That's wrong. So the dividend yield in CBA right now is 3.26%. 3.26%. And then what I did is just CBA term deposits, and you could get term deposits with CBA. I'm assuming 4.5%. There we go. 4.75% over the next 9 months, which is higher than the dividend yield. And this is lower risk. Term deposits are by nature lower risk. So you actually should expect the term deposits return should be lower than dividend yield. I'm just amazed that the term deposits are significantly higher than the dividend yield you can get from the CBA. And there's also much more risk holding the banks. The other thing I did is have a look. Actually, the other thing I should show you is the typical dividend yield for CBA. So if you go to financials, I'm already on it. That's awesome. This is a dividend yield over the past 10 years. In fact, the dividend yield has, before COVID-19, was always between 5 and 7%, which is the sort of dividend yield I would expect from the banks. Now it's at 3.26%. In fact, you don't or have not seen it any lower than this over the past 10 years. Just recently, about a year ago, just before this massive rally in the share price, the dividend yield of CBA was about 5%. That is what I would expect from the CBA, between 5 and 7%. At 3.26%, it's at the lower end of its usual range, definitely at the lower end. So that's CBA, historical dividend yield. It's on the low side, historically, and also it's below the term deposits. Okay, let's have a look at Westpac. So we assume that FinChat is good with the dividend yield. So let's have a look. Oh, but before we have a look, let's have a look at the historical dividend yield for Westpac. If you go to ratios, you should see a dividend yield here somewhere. There it is, dividend yield. And this is the typical dividend yield for Westpac over the last 10 years. And typically it ranges between about 5 and again 7%. Right now it's at 4.63%, which is interesting because that's the term deposits. So I'm just going to assume you can get a 4.75% term deposit with Westpac. So right now, the dividend yield for Westpac is fairly similar than the term deposits. But again, there's more. And this also doesn't include any franking credits. But again, there's more risk with owning the banks because the share price has run up a lot and there is possible downside moving forward. And also, what's the expected returns? We just don't know the expected return. So if you're just relying on the dividend, there could be some disappointment in the future because the dividends aren't rising at all for the banks over the last 10 years, by the way, over the last 10 years. So that's Westpac. Maybe we'll have a look at NAB, or not NBA, NAB. And I assume NAB is fairly similar than Westpac. Again, dividend yield. What if I could do all the banks in the one? Anyway, NAB is at 4.4%. And again, prior to COVID-19, the dividend yield of the NAB was between 5 and even 8%. Even 8% you could have got back in 2018. If I saw 8% dividend yield for the banks, that's a nice little return. And again, ANZ, you're just relying on the dividend yield. That's it. So let's have a look at ANZ. Or you're relying on the dividend yield. This company has not grown. In fact, the only returns you've got from ANZ over the last 10 years is the dividend. And so right now, the dividend yield for ANZ is at a nice, actually nice is probably the wrong word, is at 5.34%. So higher than the other banks. But again, this is all you're relying on. All you're going to get from ANZ, based off history, is a 5% dividend yield with a bit of franking credits in there. And to be honest with you, if you have a look at ANZ right now, the dividend yield is fairly similar than what you might expect. So prior to COVID-19, the dividend yield ranged between 5 and 8%. So in fact, ANZ might be okay value right now. It's up to you again. In regards to the second bit, she wanted to buy shares now as she's worried once interest rates start to drop next year, then more investors would seek out shares for higher returns. That's actually, there's some logic to that because if interest rates start to drop, term deposits start to drop, and people would want to put their money into other assets classes. But the question is, if the shares of the banks keep on rising, dividend yield keeps on dropping, and they become way less attractive to income seekers. And I can tell you right now, there's a lot of other companies out there that have really attractive dividend yields. And I think there's less risk in those companies than even the banks because don't forget, the banks are cyclical. So there's only so far that the bank's share price can rise before they become unattractive to even income seekers. Okay, so that's what I'm going to talk about when it comes to this particular video on the 4 big banks. Hopefully, I've left my opinion out of everything I've been discussing, my commentary. Hopefully, you won't know that I am not that in favor of the banks right now. I've just given it away right there. But I think if you do watch my videos, you know I do think the banks are significantly overvalued and the potential future returns are quite low moving forward. Anyway, and by the way, the charts look absolutely stellar. So I do look at the charts at all the banks, and the charts look great. If I didn't think they were overvalued, I could imagine myself trading these. But again, even when you do technical analysis, value matters. You're more likely to get really good returns when you use charting or technical analysis on good value companies or cheap companies, not expensive companies. Anyway, charts still looks good for CBA. No complaints there. Okay, so if you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.